Good morning, everybody, and Merry Christmas from Marquette and Boston and wherever you're at. Obviously, you're probably as busy as we are as we all get prepared for the season, but we wanted to take a few minutes to number one, say thank you for being clients of ours and friends of ours. We really value your relationship with us. And second, to give you a little bit of an update on what's been going on in the markets. With me today, with my staff, Jessica Kinnunen, and our portfolio manager, Bob Key. And let's get right into it in the interest of time. Bob, we just sent out a note to our clients this week explaining that we are bringing some international exposure back into the portfolios. This is something that we haven't had since pre-pandemic. Could you elaborate on that?
Yeah, it's let's go back to our reasoning for why we eliminated international exposure, and that we'll get to why we are adding it back in. When the pandemic hit, we were very concerned, as was everybody, with markets in general. And one of the things, excuse me, that we identified was that the global trade, as it shut down around the world, some economies were going to get much more impacted by it than others. The advantage the U.S. economy had is that because we're such a domestically oriented economy, in particular, about 70% of our economy is our U.S. consumer, our economy was going to survive a slowdown or even a shutdown of global trade much more so than these export-oriented economies of Europe and Asia. That certainly proved to be the case, and the U.S. economy has clearly outperformed over the last 3 years, and the U.S. stock market has outperformed. The other wrinkle to that is we were very concerned about what it meant for currency, right? If you're a U.S. investor and you're investing over in Europe or Asia, you're investing in their currency, meaning that if we buy something in their currency and that currency depreciates against the US dollar, that's an additional loss for US investors. So fast forward to 3 years later, the dollar has been strengthening for 3 straight years. And as we enter this scary period of the Federal Reserve starting to change and back off of their super tightening policy, this is a period where typically the US dollar starts to weaken against foreign currencies. That's something we're very concerned about, because that means that there's an added tailwind if we own international securities. And also, if we look at what European markets are doing, the valuation is much more attractive in European markets right now. The dire consequences of the war in Ukraine didn't really pan out. The European economies are actually starting to do fairly well again. And we simply we took a very aggressive underweight to international markets, and we're just cutting that underweight in half right now and getting some international exposure back in. We still remain underweight international markets relative to US, but we wanted to cut some of that underweight.
One more thing on international, specifically, we're only doing Europe right now. Can you elaborate on that?
Yeah. Asian economies, and we say the Asian economies, it's what we're really talking about is primarily Japan at this point. We don't, importantly, within our investment process, we don't systematically invest in emerging markets. We only do developed economies. And our reasoning for that is that emerging markets have, when we go back and we take a look at that, they've systematically underperformed developing economies. There's always this story out there that they're going to, because it's where the growth is, that they're going to, do wonderful. And really, if you look at the numbers, what you get is higher volatility and lower returns in emerging markets. It doesn't mean that there's not the occasional period where it can be advantageous, and we allow ourselves to tactically allocate there if we see those opportunities, but we don't systematically allocate there. So when we say developed Asian economies, it's primarily Japan. Japan's economy continues to just struggle, and their biggest issue over there is demographics. They're simply a very old economy. Younger people consistently move out, and they really have had growth, GDP growth far below all the other developed worlds for a long time. And we don't really see that changing, Bruce. And I'm not sure it's going to take for us to get back into Asian markets. But we're comfortable that the European economies are turning around. We're not seeing as much in Asia.
Bob, we have been making some changes to the bond portfolio. Can you make some comments on that?
Yeah. One of the big, excuse me again, one of the big moves we made earlier this year was to heavily underweight duration. That's called interest rate risk. As the Fed started tightening January 3rd, they came out and said, we're going to start tightening monetary policy. For all the complexities of econometric modeling and all that, one of the most straightforward things is when the Fed raises interest rates go higher. You don't need a sophisticated model to tell you that. When interest rates go higher, investors lose money on bonds. So what we did is we just eliminated or took out a lot of our interest rate risk at the beginning of this year. And we've seen interest rates generally go from close to 0 to about 4% during this period. This enabled us to not have to suffer those losses if we had just kept our interest rate exposure on. And now that we're at these 4% levels, we decided the Fed was clearly showing that they're starting to pivot towards a more easing, if not easing, a non-tightening scenario. They're close to being done raising interest rates. So we added that interest rate exposure back in. Since then, bond yields have rallied back down. The 10 years back down about 350. So investors can make money by having interest rate exposure again. That's why we've added that back in.
Bob, to all you out there, just so you know, Bob is modest about most things, especially how he does portfolios, because when he gets it right, he doesn't want to brag about it because he feels like he might be taking a chance and cursing himself. He's not modest at all about his golf game or his ability to dance. But when it comes to the portfolio management, I want to point out some of the things that Bob steered us away from. And ironically, over the last 2 years, there are some of the things that people have clamored for the most. That includes overweight in the FANG stocks. Those things have been destroyed this year. We've been underweight in that category, thankfully. Never went near crypto. We've stayed away from precious metals because there are short periods of time where they look appealing, but long-term they're losers, much the way emerging markets have proven to be. And so I want to say thanks to Bob. As our portfolio manager, he does the macro things, and then Jessica and I take care of it at the micro level, which is your level in your household. Really, really grateful that we haven't taken the big bets or the big risks. And as mentioned in previous videos and commentaries, on a relative basis, we've had a phenomenal year for performance. Unfortunately, the real number is negative, but it's not as bad as it would have been had we chased after some of these other things. Do you want to elaborate on any of that, Bob?
I'll elaborate a little bit on our process in general, in that Bruce, you and I spent an awful lot of time going through the numbers and why we do what we do. And it's not the job of each investor to understand necessarily what we do at the most finite levels that you and I go through. But yeah, there's a lot of conventional wisdom out there that really, when we look at, we have to have the courage to not just kind of jump on. You mentioned cryptocurrencies, you've mentioned gold, emerging markets, et cetera. And one of the ones along those lines, Bruce, is the concept of stocks are risky, therefore you have to put all your money into bonds. We don't have all bond portfolios because we understand that all bond portfolio is actually riskier than a portfolio with mostly bonds, but also some stocks. The all bond portfolios this year have quietly been the ones that have absolutely gotten crushed because of all they had in them was high interest rate exposure and credit exposure, and credit spreads widened. So yes, the so-called ultra conservative all bond portfolios, which we always steer away from, is another area where in a strange way, by not becoming overly conservative, we actually benefited investor portfolios.
And I'll kind of add on to that too, Bob, with all of the changes that we've made over the past year really. If you have outside 401ks, definitely want to take a look at those statements, just because we think that we want to make sure everything is working together with your portfolios with us and with your outside investments as well. So definitely want to send over some statements for Bruce and I to take a look at.
Yeah, that's a great point, because even though you maybe have your 401ks linked in our financial planning software, we can't trade them. And we've made some significant moves. And if we're only seeing you, once every 6 months or 9 months or 12 months, we may not be keeping up, or you may not be keeping up in those portfolios we're not managing. Bob, any final thoughts before we bring it in for a landing?
Final thought is that we've been extremely active in our portfolio management. It's been beneficial, but it's also at some level, I'm sure, exhausting to investors and exhausting to all of us as we, I shouldn't say exhausting, but it's a lot. It's a lot, and I'm looking at 2023. I do think it's a return to more normal times. Hopefully that means fewer portfolio adjustments and maybe welcomed fewer communications on those portfolio adjustments from Bruce and I.
All right, to finish it up, Jessica, what's your favorite Christmas movie, and what do you want to say to our clients about Christmas?
Oh, my favorite Christmas movie. I am just a fan of Christmas all around, but I would probably have to say Home Alone. I love that movie. Yeah. And as far as to say to everybody, I hope that you enjoy Christmas with your family and friends and stay healthy and happy and enjoy the holiday season.
Thanks. How about you, Bob?
Oh, we're gonna go right to Christmas Story, Bruce. You knew that with Ralphie. How do we not with the Red Ryder BB gun and all that? As a child of the 70s, I actually remember asking for the Red Ryder BB gun before this movie actually even came out. So it really has always struck a chord with me. But yes, Merry Christmas to everybody, and thank you for all that you do.
Thanks. And since you stole my movie, Bob, I'll take Pam's movie. Her favorite movie is It's a Wonderful Life. And I would just say that we all have a wonderful life. We have blessings. We hope that you are blessed this Christmas season as well. Merry Christmas.
Merry Christmas, everyone.
Thank you.
Pretty sure it's stop recording.